Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Slate Office REIT stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or sell. Slate Office REIT owns 34 office properties, 32 in Canada and 2 in the US, both in Chicago. The properties total 6.9 million square feet. They have quality cash flows because 60% of its tenants are either government agencies or high credit companies. The average lease term is 5.4 years, so there is a long runway of cash flows locked in. 44% of its rent is from top 10 tenants that are all high quality companies such as SNC-Lavalin, CIBC, and Kraft Heinz. A REIT must pass on at least 90% of its taxable income to investors in the form of a dividend. Investors looking for high dividend paying stocks tend to buy REITs. Since most of the profits the REIT generates goes to the investors, that can make it difficult for the company to grow and scale its business. For that reason, the stock price for a REIT will not have the opportunity to 5, 10, or 20x like a Tesla or Amazon, for example. This REIT claims companies will rent out larger office spaces due to COVID-19. The reason is because employees are too close to each other currently, and with a larger office space, you are able to socially distance everyone. It is an interesting theory, and if it is true, it can benefit Slate and other companies that rent out office real estate. They are managed by Slate Asset Management, and the company is headquartered in Toronto, Ontario, Canada. It was founded in 2012. It started trading in 2012 and can be found on the TSX and Pink Sheets. We're going to look at the ticker that trades on the TSX, so all the numbers in this video are in Canadian dollars. It also trades on the Pink Sheets, ticker SLTTF. Let's get started with the model. This is a small cap company, 364 million market cap. They're trading at $5.37 a share, and they have 68 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have positive and pretty consistent free cash flow each year. It was the highest in 2018 and the lowest in 2020. Net income is the profit or loss on the income statement. It's revenue minus expenses. Excluding 2020, their net income is pretty consistent. It was really low in 2020. Revenue is the sales for the company, and that peaked in 2019. It dropped in 2020, and it dropped a little more in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their revenue from 2019 and 2020. About half their revenue comes from base rent. They receive a good amount of revenue from operating recoveries. These are expenses charged to the tenant for running the property, such as water, gas, cleaning, etc. They also charge each tenant property taxes. These are the taxes that are relevant to the size of their unit. And they have one hotel property. Hotels fall into a different category according to IAS, International Accounting Standards. That's why they separate out the hotel rent from the others. And I believe straight line rent is the adjustments. Cost of revenue is a cost to maintain the properties, the payroll costs, and also the cost to buy materials and supplies. Revenue minus cost of revenue gives you your gross profit, and that was the lowest in the trailing 12 months since they had the lowest revenue. Below that is operating expenses. Here's a breakdown of their SG&A fees. They paid $5.1 million to the asset manager for managing the portfolio. And professional fees, these are probably fees for accountants or attorneys. And since this REIT is part of a trust, they pay trustee fees. And bad debt expense is the rents they don't expect to receive. And then there's other expenses. Below that is depreciation. Since they have so many properties, they're going to always have depreciation expense. And they do have positive operating income every year. They do have a lot of debt. They paid over $43 million of interest on their debt. Since REITs have to pay most of their profits out as dividends, they don't have much money left over to buy new properties, so they usually do it with debt. And the bottom line of the income statement is their net income, which is positive every year. The reason it's so low in 2020 was its negative $32 million in other income and expenses. Other income and expenses are usually investments or write-offs. When I looked at their annual report, it looks like most of their other income and expense items were adjustments to the fair value of its real estate or derivative contracts. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash. because net income is your accounting profit or loss. It's not actual cash. They do have pretty consistent operating cash flow each year. And CapEx is the investments for new properties. So they spend a good amount each year, between $18 million and $27 million in CapEx. Operating cash flow minus CapEx gives you your free cash flow, and that's pretty consistent each year. It is going down, but it's fairly consistent relative to their revenue. In 2018, they added $100 million of stock and $85 million of debt. But since 2018, they've been paying down a lot of debt, over $250 million, $130 million. But how do they pay down so much debt with only $22 million of free cash flow? And pretty much all this free cash flow goes towards dividend payments, so they really have no cash remaining. This is from their annual report. This is their cash flow from financing section in the statement of cash flows. So in 2019 and 2020, they mortgaged their properties for $134 million. That's how they got the additional cash flow to pay down the debt. It looks like they needed this money because they had a lot of mortgage repayments due, $163 million in 2019 and $74 million in 2020. So when you have so much real estate, you tend to have a lot of equity in that real estate. You could just refinance your properties or take a second lien against your property to get financing to pay other bills. The distributions on REIT units, that's their dividend payment, and that's $27 million in 2020. They have over $600 million of equity. They raised $520 million from selling their business, and they profited $100 million from running their business. Retained earnings is the sum of all your prior net incomes minus the sum of all your prior dividends paid. Let's look at the capital structure. $600 million of equity, $1 billion of debt. They're 39% equity, 61% debt. And their weighted average cost of capital is 8.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $437 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $396 million. We divide that by 68 million shares. And we get a calculated stock price of $5.85. They're trading at $5.37, so they're trading at an 8% discount. It's a buy according to the model, but it's really close to where they're trading at. According to Simply Wall Street, the average analyst projects their revenue to grow 2.6%. I grew their 2020 revenue 2.6% into 2021, that 2.6% each year after that. That's how I got their future revenue numbers. To get their future free cash flow numbers, I needed to figure out what percent of their revenue they convert to free cash flow. So I took the sum of these 4 free cash flow numbers and divided by the sum of these 4 revenue numbers, and now it's 13%. And I multiplied 13% by the future revenue estimate. That's how I got the future free cash flows. So it looks like the stock is trading pretty close to intrinsic value. Simply Wall Street is a little higher than me. They're at 734. They're saying the stock is 27% undervalued. This is where the stock has been trading since 2013. So it was trading at about $10 in 2013. Now it's down to $5.37. It's in a fairly tight range. So you can tell the stock never 5 or 10x from any point in time. But it did take a big dip during coronavirus. It fell to about $3 to $4 a share at its lowest point, but it has come up since the bottom. But it's still trading well below pre-COVID numbers. This is a candlestick chart the last 6 months. The stock was at its lowest point 6 months ago. Then from mid-May to mid-June, the stock jumped up a lot and has been pretty flat since that point. I think a big reason for that is because of the soaring rent prices. It seems like every week they're breaking records on rent prices. So far in 2021, real estate stocks have been one of the best performing stocks in the market. They pay a monthly dividend of 3 cents, and they pay a great dividend yield, 7.37%. They pay out 46% of their net income, 132% of their free cash flow. That doesn't look good, 132%, but that's for just 1 year. If you look at it over a longer time frame, it can't be over 100% because they'd be out of business. Their industry pays a 4% dividend. They're way above their industry at 7.4%. The stock is a little more volatile than the market since they have a beta of 1.29. It went up 48% the last 52 weeks. If you add the dividend, it's over 55%. The S&P 500 went up 35%. The 52-week low was 340, the high was 548, and the stock is trading above its 50-day and 200-day moving average. Only 150,000 shares are traded each day on this stock. Pretty much all the shares outstanding are on float, 8% are held by institutions, and 3.5% of the shares are shorted. In the past year, this stock has done really well, better than its industry and the market. But the stock has struggled the past 3 years and 5 years, much worse than its industry and the market. Analysts are projecting their earnings to decrease 28%. That's surprising. That's a big decline. And their revenue to increase 2.6%. The company that manages the fund, Slate Asset Management, owns 2.5% of the stock, then Dimensional Fund, RBC, Vanguard, and BlackRock. They have amazing price multiples, a 6.3 PE, a 2.1 price to sales, and a 0.6 price to book. This indicates the value of its net assets is greater than its market cap. This is from one of their presentations. If it sold all of its properties in its Greater Toronto area, it would be able to give each shareholder $3.35. If it sold its properties in Atlantic Canada, each shareholder would get about $3. If it sold its 2 Chicago locations, each shareholder would get $1.73, and the Western Canada locations, each shareholder would get 66 cents. So the value of its assets after it pays down all its debt is $8.77, which is more than the stock is trading at today. It's trading at $5.33. Usually it's the other way around. Usually the stock is trading much higher than the value of its net assets. This is like you're taking no risk when you buy this stock. Of course there is risk. They're not going to liquidate their entire portfolio today. But as long as nothing extreme or catastrophic happens, it's a really good value. Their return on invested capital is kind of low at 4.5%. They do have a lot of debt, so they can only cover their interest payments a little less than 2 times. Their ROE is good at 9.5%. They have a really low current ratio and quick ratio. They can only cover 10% of their current liabilities with their current assets. This would be really concerning if they didn't have positive cash flow. If they had this low of a current ratio and they had negative free cash flow, I'd be really concerned. But it looks like they always have a really low current ratio. You could look at it in 2 different ways. You can say the company is at risk of going into default, or you can look at it and say they're really, really efficient. Because when cash or anything sits on your balance sheet, it's adding no value to you or the company. Like when you buy inventory and it just sits on the balance sheet, it's like sitting in a warehouse collecting dust doing nothing. But once you use that inventory and you sell it to a customer, or you use a part of a product and sell that product to a customer, then the inventory comes off the balance sheet and goes onto the income statement as revenue and profit. So if a company had a really high current ratio, they're not using their current assets to benefit you. It's just sitting there on a balance sheet doing nothing. Of course, there are exceptions. If a company has a big cash expense coming up soon, they may need to keep a lot of cash on their balance sheet. Pharmaceuticals are good examples of companies that need a high current ratio because they usually need a lot of cash during the research and development process for a drug or vaccine. So they only have $4 million of cash on their balance sheet and $9 million of receivables. So it looks like they're going to need a lot of debt financing or equity financing to fund their operations in the next 12 months because they only have $20 million of free cash flow, negative $180 million of working capital, and a $27 million dividend payment. So they're going to be short $186 million. It's fortunate for them they have lots of real estate, so they should have a lot of equity to pull from. Of course, you want to try to dive deeper into their real estate and see how much equity they have. Look at the LTV, loan to value ratios. The lower the better for those. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 7 companies in the same industry as Slate Office. And if Slate has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So when you look at a REIT, you should look at the price of the stock over funds from operations per share. Funds from operations is net income plus depreciation plus amortization minus the gain on the sale of real estate. And the lower the better for this ratio, and they're doing well at 9.9. They're below the average in the industry. And they have amazing price multiples. They have a really low current ratio, the lowest on the list. They have the highest ROE, so that's good. They're higher than average in debt, and they're a really small company, 364 million market cap. I converted all the market caps to Canadian dollars. And they pay an amazing dividend. Although True North is over 8%, but they're second to True North. So to summarize, I have them trading at an 8% discount. And if you're looking for exposure in real estate, it's much safer to buy a REIT like this. Because if you buy an actual property, you have to find a tenant, then you have to fix it up, maintain it, pay for insurance, find new tenants. It could be a whole headache. So investing in real estate through a REIT is a much cleaner and easier process. Plus you get that guaranteed dividend payment over 7%, which is really nice for a lot of investors. And as real estate prices climb, the value of this company will go up. Of course, on the flip side, if prices go down, the value of this company goes down. But that doesn't happen too much. It usually goes up over time. I ranked their free cash flows 5 out of 10, their revenue 5 out of 10, and their ratios 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.